Want to touch on this, especially since CNBC has been kind of talking about recessions a little bit more. When you get a couple down days with the stock market, that seems to come up. But this has been news for a few years now. Back in 2022, we had a lot of economists predicting recession. We had two negative quarters of GDP growth. But they did not call a recession. The National Bureau of Economic Research, which we're going to talk about on the next slide, they have some different criteria that they weigh in. GDP is one of them, but it's not the only criteria they look at. But you can kind of see here, this is why we stay disciplined, why we stay diversified. Obviously, in the good environments, this is kind of where we are with, we ended the Great Recession financial crisis with the longest bull market ever. This is the light blue line here was over 120 months, that bull market. So a huge rally after that correction. But investors had to go through a lot of pain for that. There was a period of a 50% decline, marked right here by this light blue line, about a year and a half decline that they had to go through before they kind of capitalize on this gain. And it took a few years. No one knew there was going to be a 10-year bull market ahead of them, right? So investors had to be patient. There was a number of years. I remember, I think, just from talking and working with clients, I think probably 2012, 2013. So about, 3, 4 years after the recession ended, investors finally started feeling comfortable. 2009 was a tough environment. I just showed you on the previous slide that we were down 28% at one time in '09. 2010, we weren't getting huge growth numbers. Things weren't looking completely rosy, but the market continued to chug on and ended up being the longest bull market in history. Look at the orange number here. This is the tech bubble in 2000. A lot of what I've kind of talked about over the past few years is investors sometimes have short memories, right? And they forget what happened maybe 20 years ago, and they're just looking at what happened the past few years. Any correction we've had over the past few years have been kind of mitigated or reversed in a short period of time. This year is a good example of that. We were down about 19% in April. Here we are in August. We had a 29% turnaround. The market's up 10%. So any significant pullback has been kind of reversed in a short period. COVID was another example. The market was down 34%. It basically made up that loss in the next 2 quarters. So 6 months later, we made up that loss completely. We saw a decline in 2022 of about 25% at the worst point in 2022. That was made up relatively quickly. But this was the tech bubble. And after the rally we saw in the late 90s, almost 3 years, 2.5 year decline and a 50% decline you can see here. So it's a 50% decline and it lasted about 30, 32 months. So that was a substantial period. Investors, that was a trying period. I got in the business in '99. I was on the end of the tech rally, and right at the beginning of the bubble bursting in March of 2000. And that was a trying period for investors. So if you weren't allocated properly, you really felt it. The NASDAQ at that point, at the peak in the tech bubble was at 5,000. It ended the decline at about 2,200. So lost over 50% of its value. It did not reach that 5,000 mark all the way up until 2014. So it was a 14-year pain period for NASDAQ investors. They lost over 50% of their money. They held on. They had to wait till 2014 to regain that high water mark. So that was a very trying environment. That's why we diversify. That's why we do what we do here, because these bull markets don't last forever, and some of these bear markets do extend a long period of time. We have to make sure we're ready for that.